Okay, we're going to begin talking about stocks and bonds, and this is a continuation of our unit on finance. We started some of this in class, but I'm going to continue here to keep it one as coherent entity. There are also questions embedded inside the PowerPoint that you'll be expected just to answer as just proof that you've completed viewing this and its completeness. There will also be instructions about how to answer questions and which questions need to be answered during the course of this. That being said, let's get started. So, big picture, we're going to look at several questions. The first one is, why do governments and firms issue stocks and bonds? Why are they a form of investments? Why don't they take out loans? Secondly, we're going to look at how stocks and bonds are different kinds of investments. Even though they're both ways of raising capital, there are reasons why you might prefer one to the other in different situations. And finally, why are bonds generally easier to price than stocks? Which means bonds have relatively predictable formulas that are easy to get the numbers on, while stocks are kind of ephemeral. Stocks go up and down, as we've seen in the last few days. And why is that the case? And give us some kind of models to think about what's going into the price of these different types of securities. So let's start at the beginning. It is common that governments, individuals, corporations often have expenses that exceed their current incomes. This happens when you're starting a new business. You have a lot of expenses to start up. You have to hire employees. You have to buy equipment. You have to construct buildings. And you haven't earned $1 to cover those expenses yet. So you're going to probably either have your own capital, but you're more likely going to borrow some of the money as well. And governments often have to borrow money for things like building new school buildings or expanding a new policy, and that exceeds, let's say, their tax revenues at a given point in time. So ordinarily, if you're a small business or an individual, you're going to go to a bank and take out a loan. So you're going to borrow a certain amount of money. The bank is going to charge you an interest on top of that. And the cost of that loan is going to be the amount you borrow, the principal, plus the interest. And people do this all the time to finance college, to buy new houses, mortgages, or to start out small businesses. However, governments and big businesses need more capital for longer periods than any bank can reasonably provide. Last year, the government borrowed $1 trillion more than its tax revenues. There really isn't a bank in the world that can make $1 trillion loan. Not just the United States government, but all the other governments and large corporations that are in need of capital. And so generally there's two ways for the governments and these businesses to raise that capital to finance their business. The first one is to sell ownership, which means you sell a right to collect the profits of the business. So for example, when you issue stock, there's more capital because people are paying in, contributing to the capital, but ownership is diluted. So the point is that each share of stock is one fraction of the ownership of the company. So stock is equity equals ownership. And just from a historical perspective, you can think of, let's say, the rise of democracy as an example of, let's say, issuing equity as a way of financing a family business, i.e. government. So if you think of, let's say, government is basically a family business of kings and queens, where they would pass down the family business from one generation to another, what happened in the 15, 16, 1700s is that kings were sold shares in this family business, meaning they democratized to raise the funds to fight wars, and particularly the religious wars of the 16th to 18th centuries created a lot of demands upon, let's say, the finances, government finances. So what they did is they went to Parliament and said, look, we'll give you a right in saying how we organize and run this government, as long as you're willing to contribute capital or money to the activities of the government. And you can see this in corporations too, is that many corporations started off as family businesses where ownership was concentrated in a single proprietor or a small partnership or maybe a few people inside a certain family. And as it became larger in the late 1800s, they needed to raise more money. And so what they did is they became stock companies and they issued stock. The other way that they can raise money is by selling debt. And this is what's called a bond, which is essentially an exchange for future capital for current capital. So what you're giving is an IOU. A bond is an IOU saying, if you give this money now, I promise to pay you back later. And usually the amount you pay back later is a greater amount than you're borrowing now. So if I borrow $2 today, I promise to give you $3 at a fixed point in the future. So more or less what you're buying is debt. So just to go over this a little bit more, tax laws in the United States generally make it easier to finance through debt than to finance through stock. And this leads to a lot of leverage and instability in the financing of American corporations. The reason is because in accounting laws, you get to count your debt as an expense. So you have an interest expense when you borrow money. So you can subtract this expense from your profit, from your revenues, and that leads to lower profits, and because of lower profits, you're going to have a lower tax liability. So it makes a lot of sense in the United States that if you can count the debt, the money you borrow as an expense, you're going to save money if you borrow the money versus issuing it as more equity. When you're financing through equity, it's not an expense, and therefore profits aren't affected because the equity is determined, let's say, after profits are determined. You're going to subject them to higher taxes, and this is the one reason why what some people call double taxation is that you tax the profits of the company and then you tax the owners when they get their dividends. Some people think this is double taxation. I don't think that it is. It reflects some of the differences in, let's say, the tax laws and how things are accounted for in businesses. So in the United States and in England, most publicly traded firms are financed through the stock market, and they tend to have deeper and more capitalized stock markets. Some people refer to English-speaking capitalism as stock market capitalism because that's the major way that they're financed. While in Central Europe and East Asia, you have a lot of bank financing, and generally this is welfare capitalism, which means banks usually sit on the boards of companies. They provide the capital, but they also have a say in how these companies are run. And this is a little bit about affects how corporate governance works in those countries. So I'm going to just talk about stocks and bonds in terms of what I call Winnie the Pooh's problem. So let's say, I know Winnie the Pooh likes honey.pizza, but pizza is a better way to show the fraction, so bear with me on this. So let's say Winnie the Pooh wants to buy a pizza, okay? But he doesn't have enough funds to do it. So let's say this, pizza is $20, he only has $10. So he has two ways perhaps to finance it. One is to kind of offer Piglet, a bond with saying, give me $2 now and I'll give you $3 later. The other way to do it is saying, look, you know what? If you give me $2 now, I'll give you a share of the pizza, meaning a share of the ownership. So perhaps Tigger contributes $2, and that $2 represents, let's say, 2 slices of the whole pizza. So that means that Tigger has a quarter ownership for his equity contribution. Now, these should be kind of the same thing. From Winnie the Pooh's perspective, he still raises $2. But in one case, what he's giving up is a promise of future, let's say, future money, i.e. the $3 later. To Tigger, he's saying, look, I'm forfeiting part of what I'm buying, or some control of this business, so I'm giving you 2 slices of the pizza, maybe a quarter share of a building or equipment or profits or something of that sort. So from Pooh's perspective, it doesn't really matter whether he finances it one way or the other. However, why would, let's say, one be a better deal for Tigger? So if you think of Tigger as like a stock equity investor, what Pooh is selling to Tigger is, let's say, I'm going to give you a 10% chance to win $90. And because Tiggers are generally optimistic, they think this is a great thing. Even a 10% chance is, they probably perceive it as being optimistic and therefore better than an actual 10% chance. And therefore they're going to say, that's a good deal. If you're Piglet, who's maybe a little bit more bashful and shy, maybe a little more risk adverse, they might prefer to purchase a bond to provide the same capital, and a bond can be thought of as a 90% chance to win $10. So because mathematically these should be the same type of investment, 10% chance to win $90 yields an expected value of $9. A 90% chance for Piglet to win $10 also has an expected return of $9. So mathematically they're equivalent. Now, the first one corresponds to stocks and the second one corresponds to bonds. Because they're mathematically the same, there really isn't, let's say, a rational way to prefer one to the other. The expected return on your investment is the same. However, one reflects something that a more optimistic person might want to take, i.e. a 10% chance to win $90, while another one might be seen better for someone who's more risk adverse, a 90% chance to win 10. So stock and bond prices are inversely related because they reflect kind of the general mood of the market. When people are optimistic, stock prices tend to go up and bond yields tend to go down. When things are going poorly, what you see is bond yields tend to go up and stock prices come to go down. So you see this like in recent news where stock prices are crashing, but you're seeing treasuries and bonds and other things doing relatively well compared to the stock market. A lot of this is because people are rotating out of one kind of investment and finding, let's say, a different type of investment that's more tuned to the general mood, but also maybe to their position as an investor. So our first question. The first question is, what children's story was used to illustrate the difference between stocks and bonds? If you've been listening up to this point, this should be a relatively easy question. And now we'll continue. So I was talking about recent news, and these are just two I grabbed from Bloomberg over the last 3 or 4 days. And on the top upper left corner, you see the S&P, which is one of the stock indexes, hitting what's called a limit down, which means there's a rule in the stock market that if it goes down to a certain percentage, trading stops for 30 minutes, and basically to allow people to cool their heads and do better. But what you're seeing is that a type of bond, treasuries, are going up. And this kind of indicates kind of the inverse relationship I was talking about. When stock prices are going down, okay, people are probably buying something else. They're probably going toward a safer investment class like treasuries. Another one, you see stock futures whipsaw, which means up and down, and you're seeing a change in the dollar. Now, what you're seeing internationally is that even though there might be problems in the United States, holding things in dollars is considered a safer investment. So people might invest in American or dollar-denominated securities like American stocks or American bonds because they're seeing the dollar as a safe haven when there's problems all around the rest of the world. And it's not that the United States doesn't have problems of its own. It's saying that it's safer relatively to the other alternatives out there. So let's look a little bit more at stocks and bonds. So this shows you kind of a scatter plot of stock prices. So on the vertical axes, you see the Dow Jones Industrial Index, and each dot corresponds to the value at the end of each trading day. And on the horizontal axes, you see the Vanguard Bond Index, and Vanguard is a relatively well-known investing company, and a bond index is kind of giving you kind of an average price over across a lot of bonds they hold in that portfolio. And more or less, you see this inverse relationship over a lot of data points. When stocks are high, the value of bonds are low, and when bonds are rated higher, the Dow Jones, the stock index, is lower. Now, these are not the only stock indexes or bond indexes, but this can give you a general point to what I was talking about, that empirically, it's not as logically this makes sense, but empirically it seems to hold up. Now, if you're looking at this scatter plot here, what you're seeing is kind of at the bottom, kind of a shift off, let's say, the best fit line. And what that reflects is when stock prices crashed in 2008, which is where this data comes from, is you're seeing them moving off the line, which means stock prices are dropping so quickly that bonds are not necessarily picking up the slack. But overall, that period, you're seeing kind of a relationship where one is going up, the other one is going down. Just to kind of look at it, here's just a kind of a before the stock market crash. This is 2007, so this is a year before the 2008 financial crisis. And then what you're seeing on one is traders dumping treasury notes and buying Dow Jones Industrials, which are going up. So what you're seeing is the yield on 10-year treasury notes, a type of bond, going down over this period of time, while Dow Jones is going up. Now, we know what happens in the following year, 2008, that those increased stock prices are probably going to go down, a crash, and treasuries are going to improve. But what you're seeing is kind of an inverse relationship, and that there's kind of a tie, and it's not necessarily a logical connection. It's more that when you're trading out of one type of security, you're not just, let's say, taking your money. Even if you're putting it in your bank account, the bank that holds your bank account has to invest that money somewhere to get a return, and they're looking for the best type of investment available. And generally, when stocks are going up, that's going to the best. You're going to trade out of, let's say, treasuries and bonds, when bonds are higher than vice versa. So historically, what you can think is that there are times where bonds have been better investments than stocks. And I'm just going to go quickly through this history that in the early America, from 1803, which is roughly the date of the Louisiana Purchase, until 1871, which is, you could say, the end of the early Reconstruction, and where you're starting the big the trusts and monopolies and big business of the late 1800s, bonds proved to be a better investment than stocks. Now, why would this be the case? You have to kind of think about what is a stock investment in this period of time. For the most part, it's investing in a railroad. Most of the stocks on the indexes at the time we trade on the New York Stock Exchange were railroad stocks, because railroads need a lot of money. They had a lot of upfront capital needs. But why were they not a good investment, even though we know that railroads were a big part of American history? Is that most railroads failed. You put the money in, you build some track, you didn't build enough track to get the business going, and anyone who was an original investor in that railroad lost out. And this is generally the story of railroads, is that they raised a lot of money, they lost a lot of money, and the people who made money were generally the second tier people who bought up the failed railroads and they consolidate them. A good example of this would be Cornelius Vanderbilt, who bought a variety of different railroads in our area, the Hudson Line, the Harlem Line, and combined it into what became the New York Central, connecting New York City to Chicago. At the same time, even though, let's say, pre-revolution, American Revolution, American bonds were not thought very highly of, you can attribute this to Alexander Hamilton's financing plan, that he basically said, look, we're going to pay off our debt. And governments would pay off their debt if they, and Alexander Hamilton not only took on the debt of the federal government, but also the debt of a variety of different state governments, and said, look, if you invested in them, we promise to pay them back, and did a relatively good job of financing that. And that improved the reputation, and therefore bonds became a better investment. So people might have bought bonds that were relatively shaky, and they turned out to be good investments because the government made good on them. And just one way to think about this, about the reputation of the United States, setting up things for later, is that the Louisiana Purchase only finally, the amount of money we borrowed for that only was finally paid off in the 1990s, which meant people were willing to lend money to almost for 200 years to the United States government because of the perceived, let's say, credibility and the perceived trust in the United States government to honor its word when issuing a bond. So the next period is from 1871 to 1929. And if you've taken U.S. history, what you know about this is the age of big business. This is the age of trusts and monopolies. And as we said earlier in the course, when you have monopolies, what you're doing, it might not be good for the society, it might not be good for the consumer, but it is good for the business, and particularly in generating super profits, which means if you invested a stock in an American company during this period, you probably had a company that had a lot of profits because they were able to extract it from consumers, and that stock increased in value. So in the age of big business, trust monopolies, basically from the 1870s until the 1920s, American corporations were very profitable. And as a profit, the people in the stocks had equity ownership in those companies also did very well. Now, you see, obviously, we know what happens in 1929. You're going to have a stock market crash leading to the Great Depression. It's not necessarily the cause of it, but you did see, let's say, a decline in stocks. And this happened in October of 1929. And you can kind of see, even though this is kind of on a logarithmic scale, if you look on the left-hand side, it goes from 0.1, 1, 10, 100. That's to basically normalize the differences, so you can see the changes relative across a variety of different levels historically. And not surprisingly, after the great crash in 1929, bonds were a much better investment than stocks, which were kind of beaten down through the 1930s and into the 1940s. Bonds, particularly government bonds, were relatively a good investment because the government was raising taxes, the government was issuing war bonds to finance World War II, and a lot of these were made good as the United States, the federal government basically became more reliable and was able to raise the money, and bonds were a good investment. Starting in the 1950s, really until, let's say, the 1970s, bonds become a better investment. Stocks become a better investment. This reflects the growth of American businesses, the global character of American businesses. World War II led to a lot of countries around the world destroying their basic economic system, meaning corporations and plants and equipment. And as a result, American companies probably had a relative advantage, particularly exporting to a variety of different countries around the world who had destroyed their industrial capacity. And you saw those stocks take up. But from 1968 to 2009, and this is a little bit because of the decline in 2008-9, meaning the stock markets were lower, bonds actually did better. Now, this is kind of counterintuitive because most people think the 1980s until the 2000s was a heyday of the stock market. Now, stocks did do very well, and you can kind of see in the early period that's kind of an upswing, but you had a lot of volatility. And so what you see is kind of that highest peak is the 2001 tech bubble, and the second peak is the 2008 financial crisis driven by the housing bubble and collapse. And what you're seeing is kind of really big swings in a relatively short amount of time, which means you see large gains followed by large declines in the stock market, making stocks maybe a better investment as long as you could time it correctly. If we continue this out to the present day, you're probably going to see another growth in the stock market from the bottom of 2009. But in just the last few days, what you've seen is, 5, 10, 8, declines in the stock market, which means he's kind of had another upswing and also another hard downswing. And so above the level of the stock market, you might be concerned about the volatility in the stock market, which seems to be more volatile than it has been in recent memory. So the general point here is that bonds are seen as a safe haven when economic conditions worsen because you have a guaranteed return, and maybe you think firms are not going to have a lot of profits, and therefore you don't really look into buying, let's say, ownership in companies that you don't think have earnings potential. Well, stocks are a growth opportunity, which means you're buying a lottery ticket thinking the economy overall is going to rise, and even if it's not a particularly good company, you probably think that they're going to do better in a better economic environment, and therefore, let's say the value of that stock will rise as the economy expands and creates more of a market for that. If companies were rational, they would issue stocks when the economy rises and issue bonds when it falls because of the relative demand for the different types of securities. But for the most part, they tend to be pro-cyclical, which means they issue stocks when the economy falls, they issue bonds when it goes high, and they're not counter-cyclical in financing. This is kind of like everyone following the herd rather than kind of zigging when other people are bagging. We'll talk more about that later when we talk about how people invest in stocks. So I'm going to talk a little bit more about the details about bonds now. Basically, a bond is a promise to pay. A bond is like my word is my bond. A promise to pay a certain amount of money at a fixed point in the future. And what this makes a bond is basically a post-dated check. Now, we don't see checks that much these days because people use ATM cards, and so paper checks are not. But imagine this is like a bond that I would issue. It's a Brunelli bond, and it comes due on June 11, 2025. Now, you might be seeing this after 2025, but at this point, that's about 5 years in the future. And I'm going to take this promise. I promise to pay someone $5,000 on June 11, 2025, and I'm going to auction this piece of paper off. Now, you're not going to give me $5,000 now for a $5,000 promise 5 years in the future, but you might give me $3,000 or $4,000. Now, if you're thinking, Mr. Brunelli, I wouldn't offer you that much, it's probably because you're making a calculation that there's a lot of things going on. You know, we have coronavirus, and maybe Mr. Brunelli won't survive because he's kind of up there in age, and maybe he won't be around in 2025 to pay the $5,000 out. You might think that I'm not reliable or trustworthy, and therefore, like, this promise won't be honored. If you present this piece of paper, I won't actually provide the $5,000. And a lot of other things can happen. So you're probably going to bid in a regular bond market. I might have a minimum price for the auction to go forward, so I'm not going to take like 10 cents or $1 or some small amount for this promise. But if I'm a relatively reputable organization, I'm probably going to raise something like $3,000 or $4,000 on this $5,000 promise. Hopefully in the future I'll make the money, and that'll allow me to finance the difference and pay the $5,000 to the person holding this bond. So governments and corporations auction bonds to the highest bidder. So if we compare this to a loan, what a loan's price is the principal, the amount of money borrowed, plus the interest rate. So for example, if you borrow $100, meaning the principal is $100, at a 3% interest rate, the price of the loan is $103. This often surprises people when they get a student loan or they get a home mortgage, and they kind of think of like they're borrowing it all at once, and they think, oh, it's a 4% interest rate, that's not that much. But over 30 years, at let's say a 30-year home mortgage loan, that increases the cost. So if there's something to be said that if you can pay something in one lump sum in cash, and you can cut out the financing costs, the total cost is going to be lower than if you finance the purchase. Now, contrast that with a bond. A bond price is the par value. The par value is the $5,000 that I have on the Brunelli bond up there. Whatever is a face value, that's the value of the bond. Now, I didn't receive that, right? Someone offered me less than that amount, maybe $3,000, maybe $4,000. The difference between what you paid in the auction and what the face value on the bond is the yield. So the price is what you offered, $3,000, $4,000. If the value was $5,000, it could be $5,000. Okay, the price equals $4,000. The par value is $5,000, and the difference, the yield, is the $1,000 difference. Okay, so some reasons why bonds are maybe superior to loans is that you can sell debt for a lot of different buyers, and they don't necessarily have to have a single purpose. So for example, if people did not want to buy houses, if people did not want to go to college, there wouldn't necessarily be a need to raise money through student loans or for home mortgages. People have a particular goal in mind. And very often what happens is that you have to kind of match the ability to finance with the desire to acquire that financing. And so as some of these bond posters from World War II kind of show, there's a lot of different types of appeals that you can make to someone buy a bond. You have sex appeal, you can have appeal to patriotism, a few others. The idea that everyone else is doing bandwagoning, and this one you see a variety of different types of Americans, from cowboys to suffragettes, industrial workers, all buying bonds. This one I think is actually from World War I, which is the idea that everyone, someone like you is doing this, why don't you do it too? And I think what you see right behind the suffragette is you see like a boy with an ice cream cone. The idea is that a variety of different people that you can buy into, let's say, the safest investment in the world, which is investing with Uncle Sam or the United States government. A few other ones, people who want to buy a home. Small kids, you can raise small money, so maybe they can't buy a whole bond. What they have is kind of like a sticker or stamp system, and kids love stickers. So if they have pennies and nickels, that might not be enough to buy a bond, but pennies and nickels add up, and that can raise a lot of money for the United States war effort. And this last one's kind of a little bit of like screwball comedy humor as a way of promoting the purchase of bonds as a better investment than whatever husband and wife are taking out of their out of the income. The other thing is that bonds can be bought and sold continuously, reflecting updates and changes. So, for example, you might have purchased the bond at a certain price, and that's the amount of money that a company gets, is whatever they get in that original auction. But you can buy and sell it. So, for example, if you believe the chances of someone honoring the bond go up, you might be able, a bond you pay $3,000 for and has a par value of $5,000, you might be able to sell that for $4,000 and basically get out of, let's say, the obligation and pass it off to someone else who maybe has a different risk tolerance than you do. And if things get worse, you could also sell that bond, and so the price of bonds can go up and down over time. And the bond market kind of creates a way of investing for people who are not involved in the original investment or raising the capital for a company or for the government. So what do you need to know to price a bond? The first one is you need to know about issuer credibility. Can and will the issuer of the bond make good on their promise? Now, credibility is not just, is this a good person and do they mean what they say? It also means about, do they have the capacity and the ability to make good on their promise? So someone might intend to pay back a bond, but they might not have the money, meaning their business is not good, they might not have money in their account, and even though they really, really want to pay back the bond, they just can't. And so you have two parts to here. One is the ability, and the second one is the intent. Now, this means you have to know a lot about who's issuing the bond, and you have different businesses and different governments issuing bonds, and you need a way to evaluate them. While they've been largely discredited, what used to be is there were credit rating agencies, and these agencies would give letter grades to bonds from AAA, meaning highly reliable, and there were only a few entities on the planet that had a AAA, highly reliable, to D, meaning default. This bond is likely not going to ever be redeemed. And another word for a defaulting bond would be a junk bond. And if you want to think of this as similar to a credit score for an individual, is that your credit score sends information about is this person likely to pay back money borrowed or make good on their promise. And so like a higher credit score might mean you get better credit terms. A higher grade, a bond rating can mean you can borrow money on a better terms. The second one is time horizon, which means unlike individuals, individuals only live about 120 years if you're really lucky. There's no reason why government corporations can have to die. They don't have to end. They don't have a natural lifespan. So while an individual might only have about 40 productive years to raise the money to pay off their bonds, which means you need to be able to have enough earning years in the future to earn the money to pay back the money borrowed now, even if you're a reputable individual. A government corporation can basically roll over debt in perpetuity, which means basically forever. They can take out a new bond to pay back an old bond, hopefully on better terms, and basically roll over their debt because the United States government is going to be here 100 years from now, probably 150 years from now, probably 200 years from now. Now, you might have reasons to doubt that, but generally that's the opinion of the financial markets. So the safest type of bond is U.S. short term, meaning a bond that matures in a short period of time, Treasury bond. You might say there's even safer that there's inflation protected bonds as well, but generally that's considered the safest investment. And generally other types of investments are rated relative to the United States Treasury bonds, not because Treasury bonds are perfect, because it's considered better than the alternatives, and therefore one way to relate to communicate reliability is to basically say, like, relative to a U.S. Treasury bond, how reliable this is, and therefore how much you're going to discount it relative to this. If you have lower credibility, that means you're going to be able to get a lower price, which means for my $5,000 bond, I might only get $3,000 because I'm not as credible as U.S. government. But the U.S. government right now is getting basically a negative interest rate on their bonds, which means people are giving, $1.03 for a $1 promise in the future from the U.S. government. Essentially, people are giving money to the United States. So if you have higher credibility, you're going to have a higher price, and this affects the yield. So secondly is the interest rate. And the reason why the interest rate comes in is that bonds have to compare to other types of safe investment, and the safest investment is money in your bank account earning a rate of interest that's backed up by the Federal Reserve, which determines, let's say, the price. In some way, the interest rate that they set, the short-term interest rate, sets the short-term price of money. So the bond yield always has to be greater than the interest rate. And so if interest rates change, it's going to affect what the prevailing yield is going to be on bonds, whether they are purchased now or in the past. And so as interest rates increase, yield should increase, and this decreases bond prices. So the point is, something you don't control, the interest rate for the Federal Reserve's determined short-term interest rate, or other central banks in other countries, can have an impact on bond prices. In the same way, long-term bond prices usually are seen as a prediction of what the Federal Reserve, what the federal long-term interest rate is going to be. So in many ways, bond markets act as a propagation mechanism of the short-term decisions made by the Federal Reserve, and kind of, let's say, translate that into a expected long-term interest rate. And lastly, time to maturity. If you have a lot of time, a lot of things can happen. Bond yields normally decrease as they approach the maturity date. However, in some cases, what they can do is issue coupons. And coupons are not the things where you save money at a store in this case, but the coupons means you're going to get some of the money back before the final maturity date. And so this bond here is one by Chiang Kai-shek, or Zhang Jieshi, who is a leader of nationalist China. And if you read Chinese from right to left, it says the Guangzhou's People's Government's Northern Expedition Bond, meaning that they're trying to raise money to fight. I believe at this time it's the Japanese. I'll try to read the date in Chinese. I think it is February 1st, and you know what? Let me continue rather than read it. So I think this is fighting the campaign against the Japanese, but then also later against the communists. And they're trying to raise money, but the state of the nationalist government in China at the time is pretty precarious. And so would you want to loan money to a government that might not exist to pay the money back? Probably not. So what you can do is cut out these coupons that you see on the left-hand side and kind of redeem them at fixed intervals to get some of your money back. And this is a way of the government of China reassuring. So this leads to our next question, which is, who is pictured on the Chinese bond on the previous slide? The person pictured there is Chiang Kai-shek, or Zhang Jieshi, and you can spell that Chiang, C-H-I-A-N-G, space Kai, K-A-I, hyphen, capital S-H-E-K, that's the old romanization, or Zhang Jieshi, J-I-A-N-G, space capital J-I-E-S-H-I. Those are just two romanizations of the same name. And continuing. So we'll talk a little bit more about bonds by kind of how they failed and look at the subprime crisis that occurred in the early 2000s. Bonds are a fixed income security, which means it entitles the bond owner to a fixed amount of income at a certain time. And this income that you're getting from owning the bond is secured by some type of collateral that the issuer is doing it, which means if they don't pay on the bond, you can sue and then claim some type of property or some type of income that the issuing entity has as a way of, let's say, look, they didn't pay, and so to make good, I'm going to claim some of these assets. So for government bonds, these are backed by tax revenues. And generally, in most government constitutions, it says like governments have to pay their bondholders first before with their tax revenues before they spend money on anything else. Corporate bonds are backed by corporate assets and corporate revenue streams. But particularly we're talking about mortgage-backed securities, and these were backed by mortgage payments. The idea that we're going to securitize individual mortgages and we're going to make them into bonds, and the income stream that's backing them is that as people make their mortgage payments, this money goes into these mortgage-backed securities, and people, depending on what percentage of people pay their mortgages, will get kind of a return on that bond. So Fannie Mae and Freddie Mac were public entities originally. They became private, so this is not necessarily a public or a public agency, at least not at the time of the early 2000s. They were created to securitize mortgages, and this was a way of trying to make it easier for people to finance purchasing houses, because if you lived in a relatively remote area and you had a small bank, it might not have the capital to finance enough mortgages to have growth. However, what it enabled them to do is to buy mortgages from banks, put them together in bonds, and then sell those bonds to people with larger amounts of capital, and create a collateralized debt obligation or a mortgage-backed security. And so I'm going to use the acronym CDO, collateralized debt obligation, which means a debt obligation, a bond backed by collateral. But probably the easier way to refer to it, just so we keep in track that we're talking about mortgages, is that these are securities that are backed by individual mortgages and the payments on those individual mortgages. So these were issued, and this is kind of one way that the housing bubble was financed in the early 2000s, but not by that time, is that people were trying to create these securities. People needed mortgages. So they were willing to issue mortgages to people who were frankly not credible. And this led to the problems that if you see the movie The Big Short, that these mortgages were not going to pay off. Now, several things failed. The first one is we talked before about issuer credibility, is that rating agencies overrated collateralized debt obligations and mortgage-backed securities as AAA securities. This happened for one of two reasons. The first is that they were combining good risks with poor risks and averaging those risks out. And secondly, they were buying insurance against those risks. And let's say you might be a bad risk, but if I buy insurance on you, that covers, let's say, the risk of default, and therefore I can rate it as a AAA security. And if you want to go more into the details, is that the rating agencies kind of use very poor judgment, perhaps corrupt judgment, to give these higher ratings than they should have had. And the reason why high ratings were important is that some large pools of money, particularly like mutual funds and other types of pension funds, were only allowed to buy highly rated securities. And so they could only buy these mortgage-backed securities if they had a high rating. And so they needed to have that high rating to get access to the pools of capital. These pension fund managers and mutual fund managers weren't able to buy it by law if the rating was too low. And so there was kind of, let's say, maybe some corrupt intent or corrupt actions in setting the rates. The other one is that interest rates changed. And just let me just go forward a second. So this shows you what federal funds rate was through the early 2000s. In 2001, before 9/11, there was a tech bubble. This is the first dot-com bubble, and it burst. And this was a crash on Wall Street and stocks and equities and things of that sort. And to kind of buoy up the economy, the Federal Reserve reduced interest rates from around 6.5% down to 2-3%, which is a normal reaction of like how the Federal Reserve backs up asset prices. But at the end of 2001, as we all know, there was 9/11, and this was another kind of, let's say, attack on the U.S. economy, and so the Federal Reserve cut rates dramatically even more, virtually to 1%. You could say a number near zero. Now, this had led to several things happening. First of all, low interest rates means that people were getting low mortgage rates, and this made it very cheap to finance a home purchase. So people were saying this is a unique time for low mortgage rates. It also, in a sense, raised bond prices because interest rate low means bond yields are also low and bond prices are high. So this situation existed from the early 2000s to about 2004, 2005, and this is the same period that you're seeing the housing bubble get blown up. partly because of low mortgage prices, but also because the securities that were used to finance those mortgages were relatively competitive because of a low interest rate environment. Now, what happens, the Federal Reserve raises the rate and then at a later date tells everyone that they raised the rate. So there's kind of, let's say, people don't know, and you see at the end of the graphic, we're talking about the hidden cut, is that they might cut rates, but it might not be publicly announced, and therefore the actual rate, the cost of money, cost of borrowing, is not fully known until after the fact. What happened starting in 2004 as the housing bubble was the economy is recovering, people are doing well, and so what happens is the Federal Reserve was ticking up little by little the interest rate from 1% back up to about 5%. And what that had two things. First of all, if you had an adjustable rate mortgage, that mortgage suddenly became a lot more expensive and your ability to pay it went down, which meant people weren't able to make their mortgage payments, which meant those bonds, mortgage-backed securities, were having a higher failure rate. But secondly, as the interest rate was going up, it was affecting security and bond yields, which means they were decreasing. So at 1%, maybe that you're getting 99 cents, the price is 99 cents for $1. If it goes up to 5-6%, it's now 95. And that means that you're getting, that price is getting pushed down by the higher interest rate on money. Lastly, there was kind of a time to maturity, is that these mortgage-backed securities were sliced and diced into different tranches. And so they were kind of, let's say, taking a variety of different types of mortgages at different rating pools, maturing at different times. So they might be taking someone's second mortgage payment, someone else's 35th mortgage payment, and kind of bundling together. And this made it really hard for people to figure out what was the maturity date and what was the risk on these different mortgages made to different types of buyers. If you see the movie The Big Short, it's kind of dramatizes this kind of situation. But one thing that was happening is that mortgages were given out to people like Mickey Mouse and Donald Duck. There were also what people call ninja loans. Ninja stands as an acronym for no income, no job, no assets, meaning that they were issuing mortgages to people who should not have them. And the reason why they were doing this is because they needed mortgages as a way of putting together these mortgage-backed securities, and therefore they were willing to issue mortgages to people who shouldn't have them. And people were giving incentive programs to salespeople to give mortgages to people who, frankly, mortgages should not have been improved on in a prudential environment. And so while many people like to blame the people who took out the mortgages, certainly there was a lot of pushing from the sales end to take on these debt. And frankly, most of the people who took out those mortgages did not benefit from them. So more or less what happened is that what should have been a relatively strong security became basically subprime or a junk bond. So something that was secure, everyone thought was something that could be relied on, became what we call speculative, which means kind of you bought a lottery ticket instead. So I'm going to talk a little bit about what's going on here about something Newtonian versus Brownian motion. So most of you have heard about Isaac Newton, and Isaac Newton had his laws of gravity, and he had a certain way of looking at the physical universe, which is that a set of equations, relatively simple linear equations, can explain most of the things that are going on in the universe. This was kind of upended later by Einstein. However, the word used to describe it is Brownian, and I forgot the first name, but Brown was kind of describing kind of random motions, that probability and also relativity is a better way of explaining things that are going on. So bonds are very much kind of governed by Newtonian dynamics. I gave you all the different elements you would need to determine a bond price, as long as those numbers were reliable. Even if you had reliable numbers for stock prices, it's going to be a lot more bouncing balls and kind of unpredictable and also unique situations, making it harder for even a relatively well-informed, highly intelligent person to properly gauge what stock prices are. As I showed you before in that graphic, is that we've seen a 10% decline in stock prices, followed by a 5% increase in stock prices, but followed by an 8% decline in stock prices just in the last week. And in the last week that I'm making this video, what we're seeing is that we have these rapid movements up and down. So Newtonian generally, Isaac Newton things are deterministic, which means I can, like, for example, determine like a formula, force equals mass times acceleration. Okay, and if I know mass and acceleration, I know what the force is. While the equation that determines, let's say, Brownian is like E equals mc squared, and that means energy is mass times a speed of light squared, is telling you that there's a lot more uniqueness and relativity going on. So just to explain this, and I'm not a physicist or a scientist, but I'm going to give you uh, kind of a down and dirty kind of way, a simple way of getting at this is that one of Einstein's insights with that equation is that time does not move in a fixed way. We think time like a second is 1 second is 1 second, but what Einstein was trying to point out was generally how fast you are moving affects how fast time moves. So if you're able to get into a spaceship and travel near the speed of light, you could go around the universe and only age maybe a couple of years, while everyone who was on the planet Earth and not traveling at the speed of light would have aged many more years than you would. And so something that we take as being fixed, like the passage of time, really depends upon something that's relative, like i.e. the speed at which you're moving through the universe. Newton basically said there are universal laws that apply everywhere. Einstein said like there are different laws in different areas. So one thing they talked about is strong and weak forces inside the nucleus of atoms. And that there's some times where electromagnetism applies more, and there's other times where gravity applies more. So to bring this back out of like the physics is that some things, and Isaac Newton was basically the universe is like a big clock, and the inventor of the universe is like a clockmaker who designs it, and there's deterministic laws that kind of govern how much for every movement of this gear, the rest of the mechanism moves by a fixed amount. So clocks and machines kind of fit into kind of how bonds are priced. You can put in certain data, the clock or machine is going to spit out the same output. But there are also other things that we have a general understanding of, but we can't predict individual instances of this. So for example, it's relatively easy to understand how clouds are formed, right? There's evaporation, there's condensation, the clouds form in the atmosphere, but every cloud is different. So even though I know how clouds work, I can't predict how any individual cloud is going to look. Same thing with snowflakes, same things a little bit with DNA. So when you have with, on the left-hand side is things that are risk, which means you can calculate how much, what the probabilities are of something happen. But what you have with stocks is uncertainty, which means people don't know. They can't even put a number on the probability of actually something happening. So this describes kind of, one is the world that bonds exist in, and the other one is the world that stocks exist in. And I'm just going to show you one kind of chart here. Something that was considered deterministic was the relationship between inflation and unemployment, which that is, if you had more inflation, you had lower unemployment. If you had low inflation, if you had high inflation, you had low unemployment. If you had high unemployment, you had low inflation. And these red lines kind of indicate these relationships. And what you're going to see is it seemed to work in the 1960s. The numbers fall along the line. But what happened is because there were expectations, and what happens with inflation is that people expect inflation. People are going to change their expectations are going to influence their current behavior, and that's going to set a new level. And so what you see is a spiral around where different relationships between the variables are set by this kind of undeterminate, unique, relative aspect of expectations. Because stocks are also influenced by expectations of profits, not actual profits, that means that they can be unstable. And stock markets can be a lot more volatile. And just to show you that relationship over the same time, what you can see is that what should have been kind of a linear relationship looks very nonlinear if you look at the entire history and you plot it out. Okay, so one way of talking about stocks is that they take what are called random walks. And a very good book by Burton McKeel is called The Random Walk Down Wall Street. And it kind of gets at why it's hard to predict the stock market, at least consistently. Like you might be right once in a while, but you're probably not going to be right in general. So this is the fundamental intuition here. What a stock price is when you see it like on the Dow Jones or Standard & Poor's is the price that it's the price that's being sold at a particular instant. But what you need to remember is that for every stock bought, one must be sold, which means that at that price, half the stock market thinks that buying that stock is a good idea and it's going to pay off and go up, while the other half of the stock market thinks the price is going to decline from where it's selling at. If half think it's going to increase and half goes to decrease, more or less what happens at that stock price is that it's a random coin flip. 50% think it's going to be heads, 50% think it's going to be tails, or for stocks, 50% think it's going to go up from that level, and 50% think it's going to go down from that level. So stock movements have a lot of randomness or unsystematic things, what you might call noise. And what you see over on the left, this graph shows you a computer simulation of a fair coin, where the computer is simulating the coin, and whether you have more heads than tails. And this looks a lot like the movements in a stock index, which means you kind of have these jerky up and down movements. Now, over the long term, the number of heads equals about the number of tails over 1,000 flips. But in different segments of this, you can see that you might flip a lot more heads than tails, or a lot more tails than heads, because each coin flip is independent. So the probability that the next flip is going to be heads or tails is related to is not related to what happened in the previous flip. So a lot of this is not really systematic, meaning like, well, things are going well or going poorly. Stock markets are mostly reacting to things that are unrelated to economic fundamentals. And to quote Paul Krugman, who's quoting, I believe, Paul Samuelson, a famous economist, saying the stock market has predicted 9 of the last 5 recessions, which means it's gone up and gone down, and sometimes a recession happens and sometimes it doesn't happen. So what this means is that the expected value of a stock for the overall stock market is 0. Okay, half are going to win and half are going to lose, right? When they buy and sell a stock, the person's, either the seller is right or the buyer is right, but they both can't be right. So it's going to be a zero-sum, half win, half lose proposition. So what are the implications of this? The first one is that really only brokers, people who are charging to enter these trades, profit from this because they earn transaction fees, i.e. if they charge you, let's say, $1 for every trade, that's not an actual price, it's just saying like if they make $1 for every trade, they make money if you make more trades. So they're always going to encourage you to make more trades. However, the people who are making the trades, the people who own the money or own the assets, are not making any money. What you're getting is kind of a friction that brokers are earning. And secondly, only insiders or cheaters can profit. With the stock market, it's a casino, and if I can count the cards, if I know how, let's say, the coin flips are being handled, or if I can control the coin flips, then perhaps I can know more than everyone else and maybe bet better than everyone else. And one famous experiment is that they did a monkey throwing darts at a wall where they had different stocks in the wall, and wherever the dart landed, they invested in that. That actually proved to be a better investment strategy than an expert who knew a lot about the market and knew a lot about the different companies, which shouldn't happen, right? The monkey didn't know what they were doing and they're throwing darts in the wall. The expert knew a lot about what they're doing. And so what you see is that when you're betting on coin flips, a beginner can do just as well as an expert. And so what you might see is that someone might have beginner's luck. They go to a casino, they make a bet, they make a killing on the first night. The question is whether they can continue that pattern, which means you might experience beginner's luck, but the point is that you're not going to be a beginner forever, and that luck is not going to last. One last thing, and you hear this very often on different brokers, is that the past is no indicator of future. So even though people like to talk about how well they did in the previous year, they also need to remind you that just because I did well last year is no guarantee that I'm going to do well the next year. And another study of stocks says that actually, if you pick all the stocks that went down the previous day, those will do better than if you pick all the stocks that went up the previous day, which means that there's kind of a regression to the mean, which means that things that go down tend to go up, and things that go up tend to come down. And so if you just pick winners or just pick losers, if you just pick losers, you're going to do better than if you just pick all the winners in the previous day. So go through this. Sorry. So what this makes is that stocks are kind of like beauty contests. What you're betting on the stock market is a bet on the public's opinions guess what the majority is going to choose to win a beauty contest. Because when you invest in the stock market, you're not just saying like, I think this is a good investment. You make money if everyone else agrees that this is a good investment. And you only make money if you make that determination before everyone else gets there. So for example, a lot of people are saying with the coronavirus that, hey, let's buy stock in hand sanitizer, and it'll make a lot of money because everyone's buying hand sanitizer. The problem with that is that everyone else figured that out before you did. And if you're only thinking about that now, then the price has already gone up and you're not going to be able to buy that stock on the cheap. You're going to buy that stock at a higher price, which means your returns are not going to be as great. So what you see here on the right-hand side is what's happening is that I'm not just determining what the other person is going to do. I also can think of like have a theory of mind, which means I can think set of order that I know what that other person is going to do, and then I know what they know. Like I know what they know that I know that they know, and so you're getting into infinite regress. And to make a correct stop, you might just choose correctly just by choosing it for no particular reason. But if you actually are thinking for the right reason, you're getting into a lot of things that are very subjective. You only win if you bet what the majority of other people believe that they are going to pick to win a subjective contest, meaning that a contest which has no objective value. A beauty contest means people can have different ideas, and what you find beautiful is not what someone else finds beautiful. So the price increases as more people make the same bet as you. And so what this is like is not like a game of Monopoly or kind of, let's say, being smarter than the average dog. It's a game like apples and apples, meaning that the judges in the game of apples to apples can determine who the winner is for any reason they want. It might not be because there's actually an association, as anyone who's played this game knows. They might just be doing the opposite. They might be doing, like, for example, I don't like this person, so I'm going to choose against their card. And when that's the case, it's really hard to pick correctly. You might be right one time, but the chances you're going to be right all the times in a consistent way are relatively low. What board game illustrates the challenges of picking the right stock? If you've been listening along, I just talked about how apples to apples is a good analogy for how you might conceive of the stock market. Moving on. Stocks and random walks. So I talked about this before. I'm just going to move forward a bit. So if all this is true, how can you beat the stock market? If the stock market is fair and competitive, there should be no profit. Because if you know something, everyone else knows it, and there's no, let's say, there's no difference between its fundamental value and the price they're being charged. The price represents the cost, and so you shouldn't be able to make money in a stock market. Remember, when you buy and sell a stock, half the people think it's going up, half the people think it's going down. No one should make money overall. Now, we know that people do make money on Wall Street. So how do they do it? So I'm going to talk about some general mechanisms or strategies that people use to kind of get an edge on investing in the stock market. The first one is more or less kind of a strategy monopoly. There are some investors that have a lot more money than individual investors. So institutional investors include things like hedge funds, mutual funds, pension funds, investment banks. Because they basically invest for a lot of people, or they invest a large share of the market, they can be market makers, meaning they have market power and they can move the price up and down. So for example, George Soros famously bet against the English pound, and he had enough money in his hedge fund to basically force the English government to change the price of the pound, and he was able to make a huge killing or a lot of profit on that type of position. Secondly is to use leverage, which means you can use mathematics to identify market frictions with very precise probabilities. So a lot of very smart people who have physics PhDs, sometimes they're called quants, are able to calculate or develop better computers and algorithms to find differences between the fundamental value of a security and the price that it's trading at. And it might be like a fraction of a penny, but if you take a fraction of a penny and you multiply that by 1 billion times, that's a lot of money. And if you've seen the movie Office Space, they create this program where they take the rounding fraction on a bank transaction and put it into a separate account, thinking that wouldn't be very much money, kind of like take a penny, leave a penny at some stores, and it turns out to be hundreds of thousands of dollars. So if you can make bets finding these small differences, you can exploit those differences by using a lot of money on a small difference, and the power of numbers. Lastly, the third is you can use interpersonal and intrapersonal psychology, which means if you're able to have self-control, intrapersonal, or have a better able to read what other people are thinking and their mood, you might have an advantage. So, for example, herd psychology, which means if everyone else is, Warren Buffett, I think, is famous for saying, when everyone else is panicking, you should stay calm, and when everyone else is calm, you should be panicking. Which means when everyone thinks everything's okay, you should be looking for what's wrong, and when everyone is panicking, you should look for what's right. And kind of zig when other people zag. And this is often associate what's called value investing, which means you have self-control, which means you don't look for a quick profit. You look for underlying values in stocks, and you invest for the long term. Warren Buffett is probably the most famous person, but there was a previous book called The Intelligent Investor by someone named Benjamin Graham that kind of summarizes this type of approach to the stock market. Fourth, you can have proprietary, which means you can do research that you own and other people don't have, and maybe you can buy and sell this information. So one of my relatives does this market research and provides it and sells it for companies and different investors, which is not public information. So for example, one thing they're doing right now is looking at amusement park wait times, like how long people are waiting in line at amusement parks, to see like how much people are socially interacting and whether there's real social distancing going on. And what they're finding is that in some countries, you're seeing social distancing and you're seeing the wait times at amusement parks go down. In other countries, you're seeing it going up, which indicates that they think bad things are in the future. And the last one is diversification, which means if you can bet on many different coin flips simultaneously, you're probably going to do better. If you're only betting on one coin flip, you have a 50-50 chance. But if you want to bet on like 100 coin flips, you know that 50 of them are going to pay off and 50 are not. And if you diversify your investments, and they're really diversified, which means they're independent of each other, you can maybe hedge your bets about your investments in the market. So our last thing I'm going to talk about is options and futures. And I'm going to start with just telling a story about Thales of Miletus, probably one of the first scientists of time. He's a pre-Socrates. He's one of those people who thought the universe is made up of all one essence. So the reason why he's wearing a scuba gear on is because Thales' idea was that all the world was made of water. I'll leave that he probably was wrong about that, but he knew a lot of other things. And so the story goes that one day, he's kind of the original Greek egghead, and a bunch of people are going down and saying, well, if you're so smart, why aren't you rich? Showing that, all these things that he was able to figure out, like time of day, the shadows of precise time, etc., that these really weren't worth anything. So what Thales did is he created the first, what you might call an option or a future contract. So because he understood more about maybe the harvest and about weather and things of that sort, he made a prediction about whether there'd be a good or bad olive crop on the island of Miletus back then. And what he did is that he made a deal with all the people who owned the olive presses, which you need to take olives to make olive oil. And since he knew it was going to be a good olive harvest, he basically gave the money up front, meaning he gave the money well before the harvest happened to say, look, I would like to have the right, but not an obligation, to use your olive press when harvest comes. And I'll give you the money right now instead of waiting for the harvest to come. And so you have a guaranteed, the owners of the olive presses, they have a guaranteed revenue. When it turned out to be a really good olive season, guess what? All the people who wanted to press their olives and create olive oil had to give Thales whatever he charged, because now he had a monopoly over the olive presses. So basically he made a prediction about the future and kind of made an option now, and was able to collect on it when what he predicted happened. Now, if it was opposite, he could have said, look, I'm not going to exercise my option. I paid you like a reserve amount. You can keep that money, and therefore your losses are relatively contained. So two types of options. So you can trade, what you can do is you can trade for the right to buy or sell stock, bond, or other type of security. A call option means you buy the right but not the obligation to purchase an asset at a certain price above its prevailing price, which means I want to buy the stock. Right now it's at 25. I want to buy it in 6 months at $30. Okay? And I can basically sell this right to someone. So I can say, look, I'm making a contract with you. I want to be able to buy 6 months from now this stock at $30. Okay, right now it's 25. If it stays at 25, if it stays at 25, I'm not going to make any money. So you make a profit on a call option if the asset rises above the strike price, which means the buyer pockets a difference, which means if the price is higher, let's say the price it starts at 25 when we made the contract, let's say it's 40, you have to sell to me, you have to sorry, I'm getting maybe it's reversed, so let me just pause here for a second. So if it rises above the strike price, the buyer pockets the difference, otherwise lets the option, otherwise just says, look, I'm not going to use this option. And generally a call option means I think the market is going to go up, and I pocket the difference between the price on the prevailing market and the contracted price on the option. A put option is to buy the right, but not the obligation to sell an asset at a certain price below the prevailing price, which means, let's say it's at 25 and I want to be able to sell it to you at 15, which means you're going to have to buy it at 15. Now, if the market price goes down to 10, a lower price, I can buy it at 10 and you have to buy it for me at 15, which means I'm going to pocket $5 if my prediction about the future of the market goes right. So I profit if the asset falls below the strike price. The buyer pockets the difference. Otherwise, if it goes in a different direction, they can let the option expire. And generally, this reflects a bearish future on the market. Okay, final question. What Greek philosopher is sometimes credited with the first option? And if you've been listening to the last few minutes, this is Thales of Miletus. And that's the question. So now I'm just going to go to the end. I'm going to give you like the instructions about which question. I only want you to answer the question that is in salmon, or kind of oranges. That's the third question. If you answer all the questions, you didn't do what I asked you to do. So the correct answer to this is answer the third question, and please post that on, I'm going to set up a way where you're going to send that in to me. Okay, that's all for today, and thank you very much.